Thank you for joining Mayor Brown's Global Receivables and Supply Chain Finance webinar today. This is the 7th in a series of 9 webinars that will run through November to keep our clients up to date on developments and noteworthy issues. Today we're going to be talking about non-recourse receivable purchases as well as trade receivable securitizations, and most importantly, how they work together. My name is Brad Keck. I'm a partner in the firm's finance department and global co-lead of the banking and finance practice. I sit virtually in our Chicago office and focus my practice on private structured finance and global receivables transactions. I have a number of counterparts around the firm, and you have been dialing into this series, so you've heard from some of them. Our receivables and supply chain team here at Mayor Brown is currently made up of over 50 professionals spread across Europe, Asia, and the Americas, and we're very proud to be a trusted advisor to a number of the world's leading market participants. If you're a client of Mayor Brown, you probably know that for several years now, our supply chain finance team has hosted a series of live events in New York, London, Hong Kong, and Singapore to discuss certain events and developments in the supply chain finance market. In 2019, over 600 outside guests attended these programs. Unfortunately, we had to postpone those events this year, but we hope that, circumstances permitting, we'll be able to get together again in the new year. In the meantime, we hope you'll find our webinar series useful. A description of the remaining programs in the series is contained at the end of the slide deck. Before we begin today's webinar, I'll cover a few administrative matters and then we'll get started. First, at the bottom of your screen, you'll notice there are multiple buttons you can use. Answers to some common technical issues are located in the Help section. Also, in the Resources list is a PDF of today's slide deck. This webinar is being recorded, as we normally do with these programs. In a day or so, we will be sending you an email with a link, which you can use to listen to the webinar again or share it with your colleagues. The recording will also be posted on our website for future use. Finally, although so far this series we haven't had the best success with this, we do plan to allow time during the program for questions. To submit a question electronically, please use the Q&A button. If we don't get to your question during this webinar, we will make every attempt to follow up with you afterwards. With that, I'd like to also introduce the rest of the speakers for today's program. Along with me is Massimo Capretta, who sits in Chicago and New York, Marin Krask from London, and Alex Dell from London. Marin, I look forward to your overview of trade receivable securitizations.
My name is Marin Krask, and I'm a partner in the London office of Mayor Brown. I specialize in securitization and structured finance transactions, and have a particular focus on trade receivables securitizations, which are often multi-jurisdictional transactions. Trade receivables securitization has traditionally been used for investment-grade companies, but is increasingly being seen as an important tool in the wider receivables financing arena. Trade receivable securitizations can be structured as off-balance sheet, and this can improve a company's debt-to-equity ratios on its balance sheet. The securitization of a company's trade receivables can be used to accelerate cash flow from a company's operating activities and to obtain working capital. In addition, it can be used as a way of diversifying a company's funding sources. Trade receivable securitization is a very useful product in that it can finance cross-border receivables originated in multiple jurisdictions. Various originators in the group can securitize their receivables using the same structure, and the cross-collateralization of the receivables can provide greater financing availability against the assets. Securitization can also be used to finance large pools efficiently, subject to any concentration limits which may be required. Most trade receivable securitizations are structured using a special purpose vehicle, or SPV. The originators sell their receivables to the SPV, which obtains financing from banks, asset-backed commercial paper conduits, or other investors. Typically, the transactions are structured on a revolving basis, with the collections on the receivables being reinvested to purchase new receivables as they're originated. The concentration of receivables in a single insolvency remote special purpose vehicle mitigates exposure to multiple legal and insolvency regimes, as the expectation is that the receivables are transferred as a true sale. The SPV will either be established as a new group company, which is typical in the US, or as an orphan company, which is typical in Europe, for example, with the shares being held in a charitable trust. The SPV will be based in a jurisdiction with tax neutrality and legal ring fencing, and sometimes a special securitization regime will apply. Certain features are typically included in order to make the SPV insolvency remote, such as limited constitutional powers, contractual restrictions on the activities of the SPV, for example, limiting it to the purchase of receivables and obtaining financing in the context of the transaction, and independent directors. In addition, limited recourse and non-petition provisions will be included in the transaction documents. Profit extraction can be achieved by way of servicing fees, deferred purchase price, and/or interest payable on subordinated loans. Tax and regulatory considerations are important when choosing the SPV's location, the method of financing, and the sale mechanics. For example, in some jurisdictions, an SPV will be required to be established in accordance with certain legal requirements, or a two-step sale may be required. The core documents for a trade receivable securitization are likely to include a receivables loan agreement or notes in order to document the funding to the SPV to enable it to purchase the receivables, one or more receivables purchase agreements under which the SPV purchases the receivables, a servicing agreement, in the case of multi-jurisdictional securitizations, a performance and indemnity deed, for example from the parent of the originator group, and bank account security and account control agreements in order to secure collections. There are a number of points to consider when structuring a trade receivable securitization, and these include the following. Firstly, it will be important to consider the requirements to achieve a true sale in each country where the receivables are being originated. Legal due diligence on the underlying contract is typically required, and in particular, any prohibitions or restrictions on assignment will need to be considered carefully. Another aspect is whether the transaction is permitted under any existing secured credit or other facilities, and whether the receivables and the originator collection accounts are subject to any existing security. Cash management and servicing procedures are also important. One key aspect to consider is the extent to which there is any commingling risk in relation to the collections. Typically, sweeps from the originator collection accounts to the SPV account will need to be in place, and security will be taken over the originator collection accounts in accordance with the laws of the jurisdiction in which those accounts are located. Finally, local law perfection requirements may need to be considered with respect to the underlying obligors. One key aspect to keep in mind in transactions which have an EU or UK nexus is the EU Securitisation Regulation. The Securitisation Regulation applies to securitizations that issue new securities or create new securitization positions from the 1st of January 2019. The first question to ask is the transaction a securitization? Under the Securitisation Regulation, a transaction will be a securitization if it is a transactional scheme where the credit risk of an exposure or pool of exposures is tranched, where payments are dependent on the performance of that exposure or pool of exposures, and where the subordination of the tranches determines the distribution of losses throughout the life of the transactional scheme. It is important to note that it's not necessary for there to be an issuance of securities for there to be a securitization under the definition in the Securitisation Regulation. If the Securitisation Regulation does apply, the parties may need to consider the relevant obligations which will apply to them, such as the investor due diligence requirements and the risk retention and transparency obligations. This slide shows a typical multi-country securitization structure. I will now hand over to Massimo Capretta, who will talk about non-recourse receivables purchase transactions.
Well, thank you, Maren. My name is Massimo Capretta, and before I go through the slides, I'll just very quickly tell you a little bit about myself. I'm a partner in the firm's Chicago and New York offices. I practice in the finance area, of course, and I I spend most of my time these days looking after what we call our receivables and supply chain finance, or our supply chain finance practice in the United States. And if you've been dialing into these slides or these presentations, you've definitely been hearing from me. So I thank you for joining us, and I look forward to the last couple, and hopefully we'll do these again in the future. We've been getting really good feedback. Talking about non-recourse receivables purchase, and I put non-recourse factoring too, although we don't like to use that word very much in the United States. Unfortunately, or maybe fortunately, this slide deck, Maren, has far fewer boxes than yours. But just to level set, when we talk about these types of products in the U.S., or at least for the purposes of this presentation, what we're talking about, just a level set, is a fairly basic receivables purchase transaction. And you can see from this slide, essentially what's happening here is a underlying commercial transaction. Somebody is selling something to someone else and generating an account receivable, and then it says bank, but any funder could come in and purchase that asset directly from the person who originated it. And obviously these structures get very complex, but just as a baseline, that's what we mean today when we talk about non-recourse receivables purchase. And moving to the next slide, I think a lot of the things that Maren said would also apply to these types of transactions. A lot of the asset level questions that she was raising about, underlying contract diligence, perfection, collection accounts, all that kind of stuff, of course, exists in these products as well. Same with, asset-based lending. So what we tried to do was create a slide that maybe talked about some of the key differences, which were, instead of going back through all of the similarities, which we've already done. So when we think about these types of products, the differences we kind of point to are the ones on the slide. So first of all, virtually all, or almost virtually all of the transactions we work on in this space are off balance sheet. And one of the main reasons I think these products are attractive is that it's much easier to achieve off-balance sheet treatment than it is with securitization. And there are a couple of reasons for that, but the most obvious being that these are usually one-step direct purchase transactions that are done on a true sale basis almost everywhere they're done, and it's very easy to conceptualize, I think, the idea. Essentially, there's an asset that's being paid for. The price paid for these assets is usually fair market value or close to it. And the advance rates are much higher than on securitization most of the time, because of that, the true sale analysis is relatively straightforward, which makes the off-balance sheet much easier to achieve and much more straightforward as well. Another key difference is that in these transactions is that almost always the funder or the bank financing them really is taking true credit risk on the obligors / buyers / account debtors of the receivables. And there is usually relatively little recourse to the originator. And you don't have the type of recourse you would against an SPV for any and all obligations. Really what you're getting covered by the originator or the supplier or the seller, same person, depending on what market you practice in, are typical dilution dispute type risks, but you're not getting any true coverage. There's very often there's no over collateralization like you would in a securitization. So you really are truly exposed to the underlying asset. Because of that, diversification, or Maren was talking about concentration limits, that doesn't exist or is not common in these types of products because you're getting a true pass-through. A lot of times, diversification is the exact opposite of what you want. Usually you want high-quality assets and as concentrated as possible. And then, another difference you tend to see a lot is, a large quantity of these types of transactions, unlike in the securitization space, tend to be uncommitted. And if they are committed, a lot of times, the commitments will be relatively short, 30, 60, 90 days, and those commitments might be on specific names. So, a specific obligor might have a specific commitment, but another one might not. And, while we do transactions in this space that do have long-term commitments, they're relatively rare. And then just a quick note, another sort of main difference is that because most of these transactions are done on a true sale basis, and they are done, a lot of times, at least in the U.S. under New York law, and they are one-step sales, loan-like concepts tend to not exist in these types of products. So concepts like acceleration upon default, late interest for non-payment, things like that, you tend not to see in these types of facilities, whereas they're still, pretty common and are sort of par for the course in trade receivable securitization, at least in the U.S. market. So I think that's all I really want to say about that. Hopefully I've created some kind of baseline and not confused everyone listening further, because now we're going to get really interesting, and I'm going to hand it over to Alex Dell, who's going to talk about some of the interplay between these types of products.
Thank you, Massimo. My name is Alex Dell, and I lead the Mayer Brown finance practice in London. I've been involved in the financing of non-securitized trade receivables for over 25 years. In that time, I have advised on a wide variety of product variations, ranging from factoring, invoice discounting, forfeiting, supply chain programs, vendor finance, dealer floor planning, asset-based lending, and more recently, fintech platforms focusing on early payment models. Trade receivables securitization has always been a close cousin of all of these products, given that they are fundamentally structured using a proprietary title transfer of trade receivables. It's the true sales technology that connects them as a family of products. ABL is a lending product, I hear you say, but I shall explain later. All that said, there are features which are common to both securitized and non-securitized trade receivables programs, albeit some key differences, of course. So to continue the theme introduced by Marin and Massimo, let's look at some of these in a little more depth. Assignability. The impact of anti-assignment language in underlying contracts of sale between commercial parties is critical to all programs which contemplate a true sale of receivables. More often than not, anti-assignment language operates to prevent the effective transfer of title to receivables from a seller to a purchaser, albeit not in certain jurisdictions such as the US, Germany, and Austria, and it's somewhat of a gray area in France. By contrast, in countries such as Australia, New Zealand, the Nordics, Spain, Portugal, Benelux, Italy, Hong Kong, Singapore, Ireland, and England, anti-assignment language is absolutely effective and will need to be waived or removed as a precondition to whatever form of receivables purchase program is being contemplated. Notice and perfection. A few jurisdictions have followed the US UCC model, such as Canada, Australia, and New Zealand with their respective PPSA registers. But most jurisdictions do not, however, have a centralized registry to protect purchasers of receivables, and as such, protection is commonly afforded to assignees by notifying account debtors that there has been an assignment of a receivable. Notice has a different legal effect depending on which jurisdiction, but in each case always improves the position of the assignee. In certain jurisdictions, notice is required for there to be a valid assignment at all, and I'm talking about Italy, Finland, Denmark, and Sweden, for example. In other jurisdictions, notice has a different effect. It regulates priority as between competing assignees. In others, again, it affects against third parties, including insolvency administrators, and is invariably a precondition to enforcement against an account debtor. In most non-securitized receivables programs, notice and perfection issues are a core consideration. If a program starts off as non-disclosed, there is always a right to notify, sometimes based on a trigger, but oftentimes at purchaser discretion. For trade receivable securitizations, the sale is typically, although not always, undisclosed to the debtor, and there is a broad range of views and approach, and little by way of consistency in the market with respect to considering perfection issues as against the account debtor. Some banks want chapter and verse on notice and perfection, whereas others don't focus on the issue as they never see themselves enforcing against account debtors in the courts of their respective jurisdictions. In both securitized and non-securitized programs, the unilateral right to stop purchasing receivables, together with the use of jurisdiction limits, dilution covenants, aging covenants, and concentration covenants, all help the financiers to monitor, measure, and mitigate risk. Cash management. In non-securitized programs, the financial institution purchasing receivables is invariably the servicer and cash manager. It has the systems and personnel to perform these tasks without needing to outsource them to a third party. In trade receivable securitizations, the originator almost always acts as servicer and can be replaced on a servicer termination event. The concept of standby or backup servicer is rare in trade receivable securitizations, although it has come up a few times more recently. Balance sheet treatment. Derecognizing the sale of receivables under IAS or IFRS from the balance sheet of the seller is common to both non-securitized programs and trade receivable securitization. What is equally common is that the seller's auditors have the only and final determination of accounting treatment. And in my experience down the years, the inconsistency of views and approach, even by partners in the same accountancy firm, is remarkable. To switch lanes, in supply chain payables programs, the focus shifts to the accounting treatment of the program for the investment grade buyer, i.e. the account debtor, and the extent to which the payables program starts to look like debt on its balance sheet. Now, the issues arising from that specific issue are worthy of a webinar on its own, as many of you involved in the supply chain market will no doubt be aware. Customer tolerance for complexity. This is a tolerance not just with respect to accounting outcomes, but a willingness to contemplate very significant multi-jurisdictional structures designed to homogenize and create efficiencies through economies of scale. 20, 30, and even 50-plus jurisdiction structures are becoming more commonplace as sectors consolidate, and these programs are seen as efficient, cost-effective, and ultimately easier to run, manage, and operate than a multitude of in-country bilateral arrangements. And this is true for both non-securitized programs and trade receivable securitization. Global businesses. Global businesses commonly trade on their own terms, given their relative commercial leverage, and as such, tend to create a pool of receivables that are similar in nature, tenor, profile of account debtor, risk profile, and therefore dilution experience and concentration. This enables larger and larger programs to be constructed and built upon with a reasonably consistent risk and yield profile for the financial institutions supporting them. Trade credit insurance. Another trend to emerge is the growing importance of trade credit insurance policies to support the pool of receivables being financed. These are relevant to non-recourse programs as well as securitizations, whether to provide credit enhancement by endorsing the purchaser of the receivables as joint insured and or sole first loss payee under the policy, or to deliver capital relief by engaging in a full-blown negotiation of the terms of the purchaser's credit insurance policy such that a CRR opinion can be issued by your counsel. Do be aware, however, that the differences of approach taken by credit insurers is dependent on whether or not the purchaser is a financial institution or an SPV. Legal true sale opinions. Whether needed by the auditors to issue their own accounting opinion for balance sheet treatment purposes, or generally as a risk mitigant, both securitized and non-securitized receivables programs invariably require a clean true sale opinion to be issued by purchaser's counsel. Unsurprisingly, they say the same thing. True sale technology is homogeneous. It's the products and the markets in which those products exist that are diverse. And finally, as Merrin referenced, permitted financing, free and clear of any pre-existing liens and encumbrances, is critical to both securitized and non-securitized programs. I have presented live to a number of you over the years, whether in New York, London, Singapore, or Hong Kong. And most recently in the fall of 2019, observed that the distinction between trade receivable securitization and non-securitized receivables programs was blurring. Where one stopped and the other started used to be more predictable than it currently is. Often, it was determined by size of facility, given the relative expense of securitization setup costs, but size alone is no longer the principal consideration. The determining factors between which product is selected still, of course, includes size, jurisdictions, complexity, but also comes down to a number of other issues. Which team? Which team within a financial institution created or was introduced to the opportunity? Whether a financial institution is good at passing leads across to other teams that they cannot or do not want to handle for any reason. Whether the general counsel at the seller or issuer has experience of one product or another. Whether the board feels a stigma associated with safe factoring, as Massimo alluded to. Whether risk retention is a material consideration to an issuer. Whether additional reporting obligations are considered unacceptable or an accepted cost of doing business. Whether the underlying purpose of the product is for working capital, as trade receivables securitizations tend to be, or balance sheet management, which is commonly seen in non-securitized programs offered to investment-grade sellers, often trading with investment-grade account debtors. The volume and spread of account debtors, and of course, pricing. Now, at Mayer Brown, we see the variety of products as a spectrum, all of which we cover around the world on a daily basis. And what we've seen is an accelerated blurring of the distinction between products in the last couple of years, such that here we are discussing non-recourse receivables purchase and trade receivables securitization in the same webinar with partners in the Mayer Brown Finance Group who traditionally sit in one camp rather than the other. And I suspect that we are talking to folks today who, within their respective financial institutions, sit in securitization teams, as well as others who sit in trade finance teams. Like you, no doubt, we now find ourselves routinely working on components of each of our respective deals because true sale technology lies at their essence, but also because the market has moved decisively to become solution providers for customers and away from siloed product offerings which either work for the customer or don't. Earlier this year, I was hired by a European investment bank on a trade receivable securitization. Not because I am an experienced securitization partner, which I explained earlier I'm not, but because they knew they needed a significant product, receivables, and perfection diligence in multiple jurisdictions, something that I and my team routinely undertake for non-securitized programs. It was then just a question of combining the skill sets within our finance group to cover the variety of components to the transaction. Equally, we've been working on a multi-billion-dollar receivables program over the last 18 months that was not structured as a securitization, notwithstanding its size and global scope, because that was the specific preference of the seller. Conversely, a sister transaction in the same sector of a similar size at a similar time was structured as a securitization because that was the preference of the lead arranger. Securitizing the receivables purchased by a receivables finance provider has also become increasingly prevalent. This type of transaction requires a detailed knowledge of the range of underlying receivables finance products offered by the receivables finance provider to its customer base, whilst also requiring the specific skills of a securitization team to properly document the suite of securitization documents, including the specific considerations around servicing receivables in a manner that still works for a frontline finance provider. We have also seen true sale technology adopted in asset-based lending. This is not because the ABL bank only has a credit policy to purchase receivables as opposed to lend against their security, which is quite common in the UK and other European jurisdictions. Rather, the underlying objective is to warehouse receivables by way of an intergroup sale in a jurisdiction that is more creditor-friendly than the jurisdictions in which the receivables are originated and to which most lenders have a regulatory license to lend. The impact of this promotes consolidation of the borrowing base through cross-collateralization in one entity, maximizes availability for the borrower, and is considered materially more attractive to both the lending syndicate and the group treasurer of the borrower group. There appears to be no end to the interaction between and interconnectivity of the spectrum of these products. This makes it more interesting for you as you seek to deliver the right customer solutions, and more interesting for us as we're challenged to combine skill sets and document increasingly complex financing structures. Back to you, Brad.
Alex, thank you for that. Very useful and very thoughtful about some of the challenges that are faced and some of the considerations that need to be made. I wanted to speak briefly about where these two roads really meet and some of the types of transactions that we're seeing that combine securitization with other methods. Primarily, of course, receivables purchase, but it comes up in a number of ways. I think one of the most common is within a securitization structure, you often see people strategizing about how to sell, participate, or finance individual receivables or groups of receivables that might be caught up in that securitization's over-concentration limits or that are otherwise ineligible, but still receivables that are ripe for financing. I'm thinking of things like certain jurisdictions that some finance counterparties are happy with, where others may not be. Government receivables in the U.S. sometimes take a bit more structure and thought. Or, as we often see, and we've talked about with many of you in the past, receivables where performance is owing. Here, a very common solution is to use the SPV and all the good benefits that inure to an SPV, and have the SPV sell these, I'll call them over-concentrated receivables, to a bank or a number of banks, or participate these receivables, these over-concentrations, to someone else who funds them in concert with the securitization. Very similar to that, sometimes people prefer, rather than selling a whole bunch of receivables, including these over-concentrated receivables, into the SPV, rather stop them before they go in to the SPV and finance them separately from the bottom of the transaction. Now, I know a number of you are thinking, well, wait a second here, don't we have some significant issues? And of course. The first issue is really an intercreditor issue. And to do these solutions, if it's only a few receivables and a few banks, you need to get in place a sufficient intercreditor agreement to allow these types of transactions to work in concert. For deals where there's also cash management on the deposit accounts, lockbox accounts on the front end, part of the task may be to coordinate the cash management and have a single entity be holding the security for both the securitization and the over-concentrated receivable sale. The more thoughtful and complete they are when they're put in at the beginning, they're able to really let additional lenders and additional products all be either securitized or otherwise financed within an SPV or within a structure, so that the borrower, the originator of the receivables, can have different solutions as time passes, and then different type of receivables are generated by them. In addition to intercreditor and cash management issues, we often need to think about, when you have multiple facilities all helping out a single company or group of companies, are things like, if they're credit insured, how do you make sure that everyone has the benefit of the policy? How is the policy allocated? Some of those are going to be issues within the intercreditor agreement. Some of those issues are going to be issues that need to be discussed with the credit insurer. There's also certain types of assets, for example, government receivables, that would require strategies and possibly a trust or other secured party to be able to divide and allocate those receivables amongst facilities. Another approach would be to have a single bank or a single fund funding, or through a securitization funding, a whole pool of receivables and participating or selling certain of those receivables or exposures to third parties. The idea would be kind of a fronting arrangement where you have a facility, the fronting bank or banks know that they're not going to fund the entire pool of receivables, and then in a separate transaction, they determine banks or other financing institutions or funds that are happy to fund parts of the securitization that they're fronting for. What's nice here in the States, if it is and can be done as two separate transactions, we think it's possible to be able to continue to get U.S. off-balance sheet treatment for these transactions. The last two are siblings of each other as well. One would be providing a separate facility to the SPV to finance some or all of the expected residual cash flows. This would be a subordinated loan or some sort of other agreement with the SPV itself that funds the residuals cash flows, either identified or on a holistic basis at the SPV. What we're also seeing is financing, including secured loans and more frequently repurchase facilities, related to financing the equity in the SPV, which is typically, in the States, held by an affiliate of the SPV. These transactions can be done on a recourse basis so that the funder gets both some access to the residual cash flows and access to credit availability of the parent. These are just a few examples, and creativity here is really the key. We think that the more universal that the intercreditor and cash management arrangements are made, and the more thought that's given to specific types of receivables that might be a little bit more of a challenge to fund is important. The better the framework and the structure that is set up at the beginning, the more modular and the more creative one can become in figuring out how to finance a company's entire book of trade receivables. So with that, I particularly wanted to see from my colleagues, do we think this confluence and complexity, do we think this is something that's going to continue, or do we think this is an isolated slice in time? Maybe Alex and Maren, what are your thoughts first from a European perspective?
Thanks, Brad. I absolutely do, and I think for a number of reasons. As I intimated earlier, it's all about finding the right customer solution. And that's going to require some flexibility and some agility of thought in terms of some of these really complex structures that come around. And I think banks have changed, actually. I think the way they approach the market is different to how they perhaps were rather more siloed in times gone by. And once people have ceased to be siloed and they get to learn about and see other products in operation, obviously that is knowledge that can't be unlearned. You know, they have that knowledge now, and they're able to use that and deploy that in a way that they perhaps were not otherwise able to before. And I think that's only a good thing. And I also think the same is happening at our law firm. You know, Maren and I, for example, we have different histories in the way that we have spent the most of the time in our legal careers, but we are more and more learning about each other's respective products and the approaches that are taken, which sometimes are being taken solely for sort of market or historic purposes. But it's a really interesting process where we're sort of developing and refining best practice, irrespective of the product or the market. And I think, to my mind, the genie's out the bottle. And as I said, I think that can only be a good thing. What do you think, Mary?
Yes, I absolutely agree, Alex. I think it's a very interesting time. And we're certainly seeing some interesting areas of overlap between the different types of products. So whereas there may have been some deals around before that are securitizations, but that don't always use an SPV, conversely, we're also seeing a lot of receivables financing products that you don't necessarily think of as a securitization, but that are using an SPV. Another area that's very interesting is the fintech side. So with the fintech companies that are coming along and setting up their platforms, this is also leading to some very interesting developments and new structures. And I think that will continue to grow. And we've also done an earlier recording on this, if people are interested, where we go into those types of issues in a bit more detail. And another thing that I've noticed is that, Mayer Brown as a firm are very good at this, because we do have areas of expertise in all these different kinds of products. And as Alex said, we are working together more and more on these products, and it's very, very interesting how they're developing, and doing that we can develop new solutions and new structures for our clients. What do you think on the US side, Brad and Massimo?
Yeah, I'll give that a try, this Massimo. I mean, it's interesting for me because, like Alex, this is, I think, my 21st year of being what I guess you'd call a working capital finance lawyer. And at different times in that period, if you'd asked me, I would have told you that I was a securitization lawyer, I was an ABL lawyer, or I was a supply chain finance lawyer. And the cool thing now, I think, is that you kind of get to be everything. And because you're kind of following the products, and the products are becoming more sophisticated and having elements of both. I mean, I think the big driver in the U.S., there are a couple of big drivers that are kind of leading to that. And then I think this is a long-term trend like it is in Europe because the drivers are organic. They're not being driven by internal forces at the banks, or I mean, they're really reflective of what's really going on more widely. And I think a couple of the biggest drivers are regulation. You know, as the U.S. moves closer to kind of a more global regulatory framework, I think some of the products that we have traditionally relied on here in the U.S. are becoming less attractive. I think there's a lot more comfort on the corporate side, that companies are starting to view a lot of these products with a lot more interest because they solve real problems that they have, and they're starting to believe that those products are robust and that they actually are sustainable. So I think the future is a lot like more of the same, and maybe even accelerated a little bit. I do want to mention just two quick things before I hand it over back to Brad. First of all, I do want to say a little bit about ABL, or asset-based lending, because a lot of people listening on this call outside of the U.S. probably aren't going to be familiar with the fact that in the U.S., ABL tends to have a pretty wide gulf inside banks with some of the trade or securitization products. They just tend to be in different parts of the bank, and the underlying philosophy tends to be different, and the outlook tends to be different. And, I think we are a little bit behind here in the States on, sort of working more synergistically with that product than we are with securitization. But I think that is coming along too, because I think a lot of traditional ABL lending units are starting to see the value of some of this technology too. And then I think one quick thing I wanted to mention was, because it came up a fair amount during the presentation, just to mention for everybody listening that there was another program like the FinTech that Maren mentioned earlier in this series. There was another program on cross-border receivables and payables finance, focusing on areas not covered by Alex, so more regulatory tax type issues. And then I do want to highlight for people, because I think we've said it about 5 times during this presentation, there will be a separate program on trade credit insurance later on in this series that you can listen into if you have any interest. And with that, I will hand it back to Brad. I have nothing further.
Thanks, Massimo. That wraps up today's program. On behalf of Mayor Brown, particularly Maren, Massimo, and Alex, and our other colleagues, thanks you for your time. We hope that you found this program useful, and we hope you can join us for the future programs listed here on this slide. Last couple housekeeping items, please. A recording and link to the materials from this program will be distributed by email to all of you in the next day or two, and please watch your inbox for invitations to our future programs. Again, thanks for your time. We appreciate it. Have a nice day.